Welcome to the Research at Citi podcast. I'm Lucy Baldwin, Global Head of Research at Citi. In each podcast episode, we bring you our thought-leading views and analysis across asset classes, sectors and economies from around the globe. Now, let me hand you over to our host today.
My name is Rowe. I am the U.S. Regional Director of Research at Citi, and my guest today is Anthony Pettinari, who is our Senior Equity Analyst covering home building and building products. And our topic today is an important one, both for the U.S. economy and in general for most people out there, and that's housing. Anthony, a lot of people over time now have been looking at the housing market, which both seems robust, seems to be doing well, but at the same time seems to be stuck in a way, right? We've seen inventory shortages, and we're also facing a moment now or a critical moment or transitional moment for the U.S. economy in terms of whether we continue to see the kind of strong growth we've seen in the economy over the last couple of years, or whether we're heading more into a slowdown. And so it's important, I think, both for our investors as well as retail home buyers to know what the condition of the housing market is. Is it stuck? Is it broken? I mean, how would you articulate the current state of the housing market?
Yeah, thanks, Rob. I mean, I think the housing market remains very challenging from a buyer perspective. So affordability is near all-time lows. Our team created an index that looks back on the ability of prospective home buyers to afford a new home. And looking back over almost 50 years, we're in, the 7th percentile of affordability. So, first percentile means least affordable. 99th percentile would mean the most affordable. And so we're really in the lowest decile historically in terms of the ability of an average American to buy a new home. There's a lack of supply on the market. U.S. housing stock is underbuilt really in the first place. But in addition to that, many homeowners are locked in at rates well below current mortgage rates. And, typically there are around 2.5 million single-family homes on the market. We're closer to 1.5 million homes today. So we're missing, about 1 million homes. And as a result, we've seen, lower number of total housing sales, lower amount of activity. We did just over 4 million sales last year. That's well below recent historical average of 5 million. Unemployment and GDP growth are good by historical standards, and the economy seems pretty strong on paper. Americans don't really have access to the homes they would like to buy in the areas they want to live in, especially compared to previous periods of good economic growth. And ultimately, that's why the market feels very frustrating to so many Americans. The market definitely, feels stuck. And I think for a lot of Americans, it doesn't feel stuck. It does really feel broken.
And Anthony, what are the factors that have led to this lack of supply of housing?
We're still feeling the echo of the global financial crisis. 2008, we called it the Great Recession, but for the U.S. housing market, it was really a depression, and it took years to work through excess inventory of homes. And a lot of builders and lenders really exited the market after 2008 or significantly dialed back activity. On the building side, we probably overcorrected to some extent. Over the course of the past decade, we've averaged, close to 1 million housing starts. Pre-global financial crisis, the average was 1.5 million housing starts. I mean, that was the U.S. average for, 30, 40 years, even at a time, when the country had a much smaller population. So, there's different measures you can use, but we estimate the U.S. could be short 3 million homes, and the market does not really have a path to close that housing deficit in the near term. 2020, kind of ironically, was going to be the first year that we might get back to that kind of normal building pace, close to 1.5 million homes. And then obviously the pandemic hit. The pandemic stimulated a lot of demand. You had a lot of Americans prioritizing home purchases because we were all working from home and schooling from home, and a lot of people were moving to different parts of the country. But the supply chain issues basically ground a lot of construction to a halt. You couldn't get building products, you couldn't get labor. And so the average time it took for a large builder to build a home, went from something like 6 months to 12 months. For many smaller private builders that still make up the majority of the market, it was much worse than that. Mm-hmm. So those are some of the issues from a supply perspective.
And interest rates, Anthony, have also played a role here, no?
Yeah, absolutely. I mean, from a lock-in effect, the majority of U.S. mortgage holders have mortgages that were originated at rates below 4%, so something with a 3 handle. Current benchmark mortgage rates are a touch over 7%, which creates a really powerful disincentive to sell your home and lose that privileged rate. So, we've estimated that it would take a pretty significant decline in benchmark mortgage rates to drive supply up to pre-pandemic levels. So, by our estimates, rates might have to reach closer to 5% to get us back to that pre-pandemic level of supply, from 7% currently. That's not Citi's interest rate forecast. I think it's not where most consensus forecasts are either. So I think the unlocking of supply by lower rates will happen, but I don't think we're going to see a tidal wave of supply driving prices sharply lower and sort of fixing this housing market. And it's important to remember that, the unlocking of supply by lower rates will also presumably be accompanied by some increase in demand, as the majority of these sellers are going to be looking for a home to purchase.
And before we talk about potential solutions, is demographics also playing a role here?
Yeah, we talked about the supply side. I think from a demand perspective, we have a demographic cohort that is really demanding a lot of housing. Millennials are now the largest generation in the U.S. workforce. Millennials are a larger generation than Gen X, and the single-family home purchase is really typically triggered by household formation, which is getting married and having a kid. So we have a lot of, what you would call older millennials, late 20s, early 30s, that are really in that prime household formation cohort. So that is definitely an important demand driver, really over the next 3 to 5 years.
And what about aging, about the elderly? Is that more stable, or how does that work?
Yeah, so when we talk about supply constraints, there really is a focus on the lock-in effect. And that is, I think, the primary driver with most mortgage holders with something like a 3% handle on their mortgage. But aging in place is also an important contributor to lack of supply, and one that's a little bit harder to quantify. Order of magnitude, that could be, sort of 20 to 30% of the issue. We have this kind of demographic pinch point where you still have a lot of baby boomers aging in place, often in much larger homes than, frankly, they need, while at the same time you have this, millennial cohort coming up that in many cases need those homes.
And Anthony, maybe you can comment a little bit on home pricing too. Is that, I know that inflation has still in many areas remained sticky. Has that been an issue? And maybe we can also, after that, touch on geographics a little bit.
Sure. You can, in terms of home pricing, you can really slice and dice home prices in a lot of different ways. You can look at median average, mean average, you can look at the MSA level, resale versus new homes. You can adjust for mix. And I think in the media, and maybe sometimes amplified by realtors, you tend to see a lot of splashy headlines around big price moves, in some communities. We really focus on the median price for new home sales. And generally on kind of an apples to apples basis, we see those prices, flattish to maybe down low single digit percentage year over year in 2024. So, there's some local markets that are seeing a little bit more resale inventories come to market, and that creates maybe a bit more price pressure. But it's important, and regionally, there has been recent focus in, southern Florida. I think Austin in Texas has gotten a lot of attention. But I think it's important to remember a lot of these markets saw, 60, 70% price appreciation over the past few years. So I think it's kind of important to contextualize, a 5 to 10% price drop when the price of the home is maybe, close to doubled over a relatively short period of time. So I think pricing broadly stable, some areas of higher incentives, some areas where price cuts are cropping up more. And so I think it may be a little bit more of a buyer's market than certainly it was during the pandemic, but I wouldn't sort of overstate it.
Right. So it's more of a buyer's market from a price point, but maybe not from a funding point in the sense of that mortgage rates remain elevated.
Right. And an availability of supply, so you do see a little bit of pressure on prices in some of these markets that were hotter during the pandemic, but your funding costs are high and the total level of supply is not great.
And you had mentioned certain local markets. So is there a geographic challenge here? I know that there was previously, and maybe, during the pandemic or post-pandemic, there was a large migration to the Sun Belt. Are there areas where there's a particular lack of supply versus some others?
Yeah, Florida and the Southeast. So, Carolinas, Georgia, those remain really underbuilt. Some of the hotter markets, like in the Inland West, I mean, you remember Boise was talked about a lot during the pandemic. Austin benefited from a lot of like tech migration. Those markets have cooled. But if you think about that kind of core Southeast, Carolinas, Georgia, Florida, you're still seeing, great job growth, white collar employment, wage growth. And so there is really a lack of housing in those states. Mm-hmm. The coasts, you think about the Northeast, you think about California, that were hit pretty hard during the pandemic or where price appreciation really lagged the Sun Belt. Those have kind of caught up. And actually some of the hottest markets from a year over year perspective now are in California, and you're definitely seeing, what looks like, the impact of the AI boom in the real estate market in Northern California. So some of those trends that we saw during the pandemic have evened out, a fair amount. You see strength in some parts of the upper Midwest, Ohio, around Columbus, those are pretty good housing markets. But in terms of being underbuilt and where we still need, structurally more capacity, Southeast, Florida remain kind of key points.
And I want to go back to something else you had said, which is post-GFC, you had said that a lot of home building had gone offline, essentially, and it's been sounds like a long march towards getting that capacity back up. So specifically about the home builders, but also, do you think that there's anything on a policy standpoint or the private sector can do right now to sort of relieve the paucity of supply in the housing market?
Yeah, from a policy perspective, I think the fundamental issue is, we have a political system where voters really have the ability to veto new housing construction at a local level. And they really do so, pretty frequently and consistently. So, everyone likes the idea of new housing and housing supply. But when it's time to build something, next to your subdivision or your home or your apartment building, it's going to create traffic. It's going to block your view. It's going to, change the character of the neighborhood. And maybe the units are too high priced or they're not high priced enough. Or, there's always a lot of reasons that local residents and voters discourage construction at a local level. And they kind of have been empowered to do so by policymakers over the years. Mm-hmm. I think in New York, in California, pretty notably, there have been recent efforts by the governors there to increase housing construction and density. But, those have faced a lot of pushback. And it's not really a Democrat or Republican issue. It's really something that we see, everywhere. So that's kind of a big policy challenge that is, multi-year and probably somewhat thorny to tackle. In the near term, just practically builders have focused on, smaller homes, easier to build formats, things like townhouses have gained a lot of popularity in recent years. But I think, practically the real lever to sort of add supply to the market is interest rates kind of moving lower to kind of offset this lock-in effect and making affordability a little less challenging.
And so when I think about that, I mean, obviously, if rates are coming down, that means the economy is slowing down. And it could be that you could achieve this. And I think what I'm asking here, Anthony, this roundabout way is scenarios here. There's a scenario where, rates stay relatively elevated due to sticky inflation. There's a scenario where we have a soft landing, which would implicate that, growth slows, but it doesn't necessarily go into recession. And then there's kind of a recessionary scenario or a more deeper slowdown scenario. I think in two of those, you might see rates come down. What's ideal and what happens in a situation if it's more recessionary or suggests that?
Yeah, I think the ideal scenario is modestly lower rates, a growing but not overheating economy. Ideally, maybe some policy initiatives to make adding supply, a little bit easier. That would be sort of the ideal scenario. In recessions, uniformly, you're going to see housing construction go down. Home builders are cyclical. They often sort of lead the cycle. So if we're into a recession, you'll see construction go down. You'll see pricing go down. And it's just so I think those are kind of the scenarios that we consider over the next 12 months.
Okay. And lastly, what are the things that we should be keeping an eye on in terms of the potential impact to the market, or I would say potential impact to your market as well in terms of home builders?
Yeah, I think, there's a few interesting developments, maybe both positive and negative that we look at. I mean, obviously we look at the big things like, rates and employment growth and wage growth and consumer confidence. Those are obviously really the keys of the market. But there's some things we're keeping an eye on. There's the recent settlement with the National Association of Realtors, which has gotten a lot of attention. Historically, U.S. realtor commissions have been, 6% paid by the seller and split equally between the buyer and seller broker. 6% is high compared to other developed economies. Often you see kind of 2 to 3% commissions in other countries. So after this settlement, the buyer and seller commission is essentially going to be kind of unbundled, and you should see some compression in overall commissions. And that has the potential to, take some cost out of the home buying process, which could be a positive for sort of activity and maybe affordability. It's not completely straightforward because, buyers are going to have to presumably start paying some commission. So in terms of how this actually plays out in the market, I think it'll take a little bit of time to see what this ultimately will look like. But I think it is something that has the potential to reshape the market a little bit. On the negative side, I mean, we see kind of tail risks around insurance rates and really climate change. We've seen, a number of home insurers exit big important markets, notably, Florida and California, on, risks around storms and fires, respectively. Florida home insurance costs have doubled over the last 3 years. They're the highest in the U.S. By some measures, they're, quadruple the U.S. average. California insurance rates are more in line with the U.S. average, but, I think part of that is just, laws in California are more aggressive about limiting rate increases. But kind of as a result of that, it's maybe harder to get insured because a lot of the major insurers have left. So, homeowner insurance costs are not the largest component of home buyer costs historically. But with the, kind of the rapid increase that we've seen in some of these states over the last 3 to 4 years, it's something to definitely watch over time. So, I think those are a couple kind of interesting trends worth watching. But again, I think the kind of the take-home message for 24 is the best case would be modestly lower rates, a still growing economy, and maybe, a little bit of a loosening of supply.
Anthony, I really look forward to that.
you and me both. You and me both, Rob. So
fantastic. Well, Anthony,
right.
Thanks so much for being on our podcast today.
Thanks for joining today's episode of Research at Citi. We at Citi Research provide the highest quality products, services and content covering all major asset classes and economies around the world. If you enjoyed this podcast, you can follow us for regular episodes. And feel free to share, like, leave a comment and subscribe. See you next time.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information and, although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed in whole or in part without the express written consent of Citi. Copyright 2024 Citigroup Global Markets Inc., member SIPC, all rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.